Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, it's that time of year, not that I've been counting or anything, but we are halfway.
It's water park season, Joel.
Yeah. The humidity's coming. It's summer.
The Splashplex in Mount Laurel. Shout out.
That also means that we have a pretty good sample size that we can take stock of 2024 and see what's been happening in the ETF industry.
Yeah, isn't it crazy? It's basically, the year's basically half over. I mean,
it's all downhill.
Time flies so fast.
Yeah, you reach the top and now it's all downhill.
It is. And we get focused on a couple things. All of a sudden you look up and you're like, okay, what actually happened so far?
Well, the market's been up. That's been one.
Yeah. Honestly, that's made time go faster because it's not different. It's like the same old kind of...
Interest rates didn't come down.
Yeah. What did anything happen?
No. It's just like, here we are a couple of months later. Okay.
I mean, besides the Bitcoin ETFs, I've been living on Planet Crypto for like the last 6 months.
Okay, so we've done this before, but halftime reports, we assess some stuff that's gone down, maybe a little sneak peek of a few things to come, take stock of everything. We've got some guests.
We do. We've got two of my favorite people from VettaFi, Todd Rosenbluth and Cinthia Murphy, both of whom I would consider OG ETF analysts. They both at some point worked at ETF.com, which was formerly Index Universe. And that to me was where I got inspired to even get in the industry. So it's always nice to have them on.
Todd, regular. Cynthia's first time on the podcast. This time on Trillions, halftime report. Todd, Cinthia, welcome to Trillions.
Thanks for having us on the show.
I'm so glad to be back.
Before we talk about the play of the first half, do you want to set the scene here a little bit? I don't know Cinthia yet.
Yeah, you don't know.
I know Todd
this
from previous recordings, but
you know
Cinthia,
Todd very well. But
yeah.
you kind of know Cinthia. I bring her up once every 6 months when I bring up the story of how when there was the pundits panel competition, I was robbed because I did uranium, which is now up like 1,000,000,000% since then. Mm-hmm. And the winner was Cinthia Murphy.
Oh,
so
yeah. I know you by your legend.
Yes. I bring every 6 months this story comes up.
What was the one that you beat him with?
TDV, Tech Dividends from ProShare.
Yeah.
Now you know why,
Eric
right?
might have won the long game on that one.
I'll just say that everyone who lost that day because I was the newbie doing for the first time has been saying that they were robbed. It's kind of a cliche at this point.
Yeah. Look, I'm just in favor of Eric getting beat. So, whatever it takes.
She crushed it. She crushed it that day, though.
I think everyone tried too hard that day. And Cinthia just was so organic and natural, and it just played well because I didn't come in second either, it's worse than I even say.
Okay, so Eric, how are we going to do this? Evaluate the first half of play.
Let's start with asset classes, Joel. So you look at something like equities, they took in $211 billion. So while it's down from like the second half of 2023, and it has peaked it once took in $350 billion. So that's the record. But I would say 211 is probably like the fourth best half on record.
Wait, it was 350 and a half or a full year?
That's for a half a year.
Okay.
Yeah. So if you look at all halves, if you compare this half to every half in existence, this would be the 4th best half ever.
But we've seen in the recent past where the equity market climbed higher and ETF investors were not participating. After the strong year we had in 2023, I think it's really encouraging to see money continue to go into equity ETFs, and in particular, some of the broad asset allocation oriented products that investors, advisors keep embracing the ETF wrapper for the 500, for the NASDAQ 100, and so forth.
This is a good point you're bringing up, actually, because last year, this time, we called the FOMO drought. Stocks were up, but the flows weren't there. So this time last year, equities took in $110 billion. So $100 billion more this year. Clearly, investors are getting in. You know why there was a FOMO drought, though? Money market funds were yielding 5%. Seems like people are like, well, I'd rather have 15, 20% in equity returns than 5% in money market. So that seems to be the difference this year.
Yeah, but within that equity sleeve, isn't a lot of it going to international equity, which I think it's a little actually speaks more about risk off than risk on. It's that search for value, which I think has been interesting. A lot of money has gone. We always talk about every year being the year of diversification into international, and we are actually seeing that this year.
International did take in its fair share, but U.S. still rules.
For sure.
But in proportion, a lot of countries and regions are having all-time highs. It doesn't break through in the U.S. media because whatever you're doing in another country out there, the Qs is beating you. It's like,
well, and money and money's going into the Qs and QQQM in particular. I know we're going to get to the bottom up.
We on our team sometimes we like how much sell side research could be summed up with by QQQ. Like, it honestly, it's really much easier than people make it out to be. I mean, just this index is just lethal. I mean, what's the point of investing anywhere else, Joel?
Well, you could do MAG, right? Just the Magnificent Seven. How does that compare?
That is interesting. By the way, are you surprised by this, that the Qs are mostly Magnificent Seven stocks? I believe it's like 50% of
Ditch the rest.
But then Roundhill's like, oh, why don't we just come out with a Magnificent Seven ETF?
Cream of the crop.
And it's got like a ton of money.
Yeah.
It just seems like it's like, really?
It was that simple. You focus on those 7 companies, 8 stocks. That's performed well, even if a couple of them have dropped off. But yeah, we're just excited to see the equity ETF adoption, both actively managed equity ETFs, which are quite strong, and even the broad index-based products as well.
Okay, what about fixed income? Because it's always been like, this is always the year of the fixed income ETF.
It's, it's always the year of something, isn't it?
Yeah, I mean,
it is. Well, you're an editorial. You got everything.
I feel like it's been 3 years running of like, this is the year.
By the way, are we doing our outlooks yet for
ETF.
next year?
I mean,
anyway, it's getting
just
earlier and earlier.
Wait until end of July.
Okay. So let's look at fixed income, $89 billion. That would be about the 6th best half ever. But I will say, if you look at a chart of fixed income flows, they used to average 35 billion a year, half a year, sorry. Now they're averaging 90 to 110 billion. So they, around 2020, around the pandemic, they just kind of went into this other gear, and they've lived up there now.
Yeah, I mean, well, we saw adoption of fixed income ETFs as the go-to vehicle for institutional investors who favored the liquidity. But you got to even put this year in perspective, because coming in, we had the overall industry expected multiple rate cuts. We haven't had any yet as the time we're recording this, and probably going to have one maybe by the end of the year. That's just a different environment, but it just shows that investors have rotated. They've been comfortable taking on interest rate risk or taking it off, but using the ETFs as the vehicle of choice.
Yeah, I would just add, just this morning, actually, I was talking to the guy who does our VettaFi Pro data analytics tool and codes all that stuff. And he runs all the portfolios. And he was telling me, like, all the behavioral data shows that by far people are playing around and trying to figure out how to build equities, even alternatives, and that fixed income is still that afterthought. Advisors are still like not quite sure what to do about it. So I think there may still be like, early innings just going for easy button choices because they're not quite sure how to position at this point.
I love the easy button. Eric knows this.
I know, he loves that. By the way, he thinks there should be an ETF, it's a logical thought, where it's just everything in the entire world in one ETF. You can just hit buy and you own it.
Easy.
But
ticker easy.
The problem is advisors want to be the deciders. Yeah. It's like you're putting advisors out of business with that, Joel. That's the problem.
But it's a great self-directed tool.
Yeah. So one thing about fixed income that's interesting
That was free, by the way. Thanks for listening.
We can create the index.
They have fixed income active managers are still in demand. And so, yes, there's some active fixed income ETFs, but the active fixed income mutual funds have taken in money. So like bond managers, I think it's because it's like there's so many bonds, the element of time is like makes it more like chess than checkers. And I think advisors still are willing to give money to a bond manager. And that will always, I think, put somewhat of a lid on fixed income relative to equities in the ETF wrapper.
Yeah, but we are seeing the products that people have gone to and the managers that they've gone to for years in the mutual fund world are now available and offering products in the ETF world. Capital Group has had a lot of success with active fixed income ETFs. PIMCO's been there the longest. BlackRock, I know we're going to talk about individual products, but BlackRock has had success with the BINC ETF that's run by Rick Reeder, just past a year, and is crushing it in terms of asset gathering. We are seeing more and more active management within the fixed income space.
Yeah, no, it's got everything. And corporate did the best of every sector in bonds this year, and Treasury's down a little bit from last year. They switched places this year again, investors taking on more risk. And then, what did really well that was kind of introduced recently is CLO ETFs. Yeah. collateralized loan obligations, which everybody kind of gets memories of 2008. But I've talked to some of these people that come on ETF. It's not as bad as, it's not as risky as you think. The JA is now $10 billion. That's the Janus.
Yeah.
Isn't that crazy?
That's
$10 billion.
We got to have a segment called They Grow Up So Fast. JA would be a great candidate.
Yeah, and that's Janus Henderson putting their best in the ETF structure, and just tremendous demand. It just shows that the ETF wrapper works for many investment styles.
Well, and just to go back to the memory of the CLOs, is we hope they don't grow up too fast. We hope we know what we're doing this time around, right?
Fair point. Yeah, you don't want CLOs to grow up too fast, right?
Okay, I want to talk about another asset class, and we've gone through the usual ones. What about alternatives?
Yeah, so alternative is a $35 billion. That would be the biggest year ever, Joel, by like fivefold. But the thing is, we put in the Bitcoin ETFs into alternative. So that's why that number is so big. If we carve that out, alternative would be having an average year. But the Bitcoin ETFs, all told, are, $15 billion about between all the new ones that came out. And then even IBIT has taken in a little bit. So that is a tremendous start. We've talked about it on the show many times. But alternative overall is just pretty small, like hedge fund style ETFs. So that number is a little skewed. But also interesting is commodities outflows this year. So it's
how much?
$5 billion. So that's also interesting is that the Bitcoin ETFs cleaned up, gold seeing outflows, even though the price is up. That was an interesting combo there with the
Cash
gold
in
Bitcoin.
on the real gold and put it in the digital gold?
It seems like that's what people did, but we can't ever tell what exactly what they're doing, but that seems like what happened.
Yeah, but we're hearing at VettaFi from advisors that are now heading into the middle of the year. They're looking towards alternative investments. They're not only looking to crypto, they're looking to gold. We at VettaFi would consider covered call ETFs as perhaps within the alternative space that are options-based strategies from Neos and JP Morgan, among others. We're seeing advisors, investors looking for something else besides stock and bond exposure using ETFs.
Yeah, and I think 2022, which was the really bad year, the 60 and the 40 both went down. And since that moment, people have said, okay, I'm open to something else that can hedge the 60-40. So I think that's where active actually comes into play. Active, by the way, having another big year. I think they've taken in like 20 to 30% of the flows again.
And not just one category. We've seen it for equity.
Across
and
all categories, yeah.
We've seen it for equity and we've seen it for fixed income, which is just encouraging.
What is it at this point? What's driving that, do you think, Todd?
I think the fact that we have supply is helping, that we have some of these leading asset managers, T. Rowe Price and Fidelity, Capital Group that I mentioned earlier, that's playing a role. But given the market volatility, and certainly in fixed income, where I certainly don't know the next move of the Fed, the average investor may not know that either, they're comfortable turning to active management to get that expertise. But they're also coming to active management for stock-specific ideas as well. We've seen some success. I know when we get to the leaderboard, we're going to see some active products there.
Yeah, but I do think the branding power that has stepped into the space has made a difference, because if you have to sit in front of a client and explain, why did you pick this active manager I never heard of and it's not working, it's a really tough conversation.
Little star power helps.
When you have
offset
that star power, really helps.
Yeah.
And also, we dug into the numbers of active. It's a little more nuanced than just, the return of the stock picker. A lot of the active is the covered call ETFs, which you could argue is people aren't buying for the manager, they're buying for the actual income. Then there's a chunk of active into like DFA, but it's equal to the amount coming out of its mutual funds. So there might be some just transfer.
Some of that
format.
is, but again, Fidelity Bond
It still
ETF.
counts. I
Fidelity
agree.
Bond ETF has been popular this year.
The other thing is the fees finally got low in active. They finally got below like the 20 basis point all important line. And the other ones are below 40. As long as you're below 40 and you're active, you have a fighting chance for organic growth, in my opinion.
Which, by the way, just back to Bitcoin, where did they come out at and where did they end up at from a fee standpoint?
Well, I remember the ARC was first. I think there was 75 in a prospectus, and then Fidelity came in at 39. Those are the first two. And then, boom, there was like a 24-hour period where Invesco was like, okay, we're 25, but we have a waiver. And then BlackRock's like, oh, we're 25 or something like that. Once BlackRock went in 25, I think they went in, everybody had to get real close to that, because you can't be too far away from BlackRock or someone won't buy your stuff. So then BlackRock, I think, then introduced the waiver. After the dust settled, Joel, all of them were between 20 and 30 basis points. I think Franklin actually went one lower to 19, and that's where we're at, which I'm surprised they got that cheap.
Well, not yet. Right now, there's still the
Zero.
waiver.
You're right. There's waivers and stuff, but I don't like to count the waiver too much because it runs out, but the fee behind it is still cheap. Because sometimes there's waivers and the fee is expensive behind it. But in this case, the fee behind it isn't that bad either, which, again, speaks to the Terradome aspect of the U.S. market, where in other countries and other vehicles, these Bitcoin funds are over 1%. So this is really monumentally cheap.
Yeah, but I'm curious to see how they unwind all the waivers. I know there's specific, dead end dates on prospectuses and stuff, but we've seen that it's really hard to go from zero up. So you end up getting a bunch of extensions and waiver to infinity. So I'm curious to see when the unwinding comes, what the reaction is.
The revenge of HODL.
Yeah.
All right, Act 2.
Okay, so we're going to go ticker. So this is the leaderboard. Top 5 inflows of the year. Number 1, you can guess it.
VU.
Yes. Well, guess the number.
25 bill?
No, higher.
40.
Yes.
Oh.
40 billion is ridiculous, okay? Just so you know, the record for a calendar year is 50. So VU is already
crushing it.
Yeah, I mean, what a monster this thing is. The next one is 16 billion, Joel.
Who's that? Hold on. Cynthia's going to guess.
IVV?
Yes. Good job. See? Told you.
Nah, it wasn't that hard. It's like the other
Well, no,
S&P.
It was very, very hard.
well,
Thank you.
It's kind of a tie. There's a tie for second. IVV is one. Another
What
one
was the other one, Todd?
It's IBIT,
yeah,
right?
that's right.
Okay.
So BlackRock has the second and the third largest ETF.
What's the figure, the actual figure?
16.9, 16.6. So IVV, IBIT. But that tells you VU is on another planet. Then you have IVV and IBIT. And then 4 and 5, you guys can guess that. That's the tougher. 1 we already mentioned on this program.
I'm putting my money on Cinthia again.
Oh, pressure.
This ticker was already
The
set on here.
Qs?
Yes.
How much did the Qs take in?
12.9 billion. So we'll round it up to 13. And number 5, we'll round it to 13. And you can get this. Come on.
I would go with Fidelity's.
No. That's 7.
Okay.
This is always in the top 5. It's always lingering. It's never 1 or 2, but it's always like 5, 4 through 6. This is a stud ETF. It just slowly hoovers up money.
This is
It's
Vanguard.
boring.
This is Vanguard Total Stock Market.
That's it. VTI. So that's your top
You
5.
you don't like it when I bring the boring ETFs to the top.
The problem is
so
it's
fixed income in there.
No, 6 is AGG, but you're right.
Oh.
The top 5 is all stocks and Bitcoin, which is, in my opinion, risk on. But yeah, I'm not too surprised by this. I think IBIT taking in 16.6 billion is a surprise to anybody. That's a ton of money for a new ETF. And the Q is obviously going strong, even though there's a cheaper option with QQQM, which is 12.
Okay, do you think IBIT can maintain this pace?
No. James and I have a calculation that the Bitcoin ETFs will net 10 to 15 billion in 1 year. They're already right about 15 billion, so they've already gotten to our ceiling. But remember, things can happen. Bitcoin could have, it's very volatile. But we're probably going to be proven wrong. But let me give you this stat we just ran. IBIT touched 20 billion in assets the other day. Barely. It's down to like 19.8, I think, right now. But it touched 20 billion. It reached $20 billion in 57 days. The next fastest ETF to reach $20 billion did it in 940 days. Can you get the ticker?
Ooh.
Well, I would think it's GLD.
It's a
No.
deep cut.
So it's a more recent one.
Oh, that's Sheppy then.
Yes.
Okay. I was trying to
Good
think if
job.
it was recent.
So anyway, this thing is breaking all kinds of records.
I just think it's impressive. Well, first of all, VU on its own, that's going to hit the record, as you mentioned, is impressive. We've got those two, IVV and VU, and SPLG, which is the State Street low-cost ETF. That's also punching above its weight and gathering assets. I just come back to, it's just so exciting that this is how people are starting to get exposure to ETFs, is through the S&P 500, and then we're seeing the next wave that's narrower slices or Bitcoin or what have you.
It's interesting, and Ethan looked at this last year. The percentage of flows going into the S&P 500 ETFs, there's now 4 of them. We got an SPLG, and they're all, again, almost free. but it's got to be over a quarter of the flows. So even though we talk about these niche things, there's cheap beta is just the real deal. It just hoovers in cash, hand over fist.
Yeah, but the Bitcoin is
the shiny object.
Yeah. I mean, super shiny. And in the case of the success of the launch, part of it is, the ETF wrapper, that's awesome. We're all super, pro ETFs here. But part of it is Bitcoin is a new asset. So can we repeat that? Unless somebody comes up with a new asset, I don't think we'll ever see something like that again. I don't even think the Ether ETFs would be the same phenomenon. I think, for one, we're all tired. It all happened in the same year. I don't think we can take much more.
Oh, you're going to get to.
You know what Ethan said today when someone filed for a Ether spot covered call ETF?
Yeah, no.
Make it stop. It's never going to stop. Anyway, one more thing I agree with you. Ether maybe takes 20% of what Bitcoin has. But Joel, what she just said is something that I've been trying to explain to people who might not love the fact that I've gotten so into it. It's a once-in-a-lifetime opportunity or situation as an analyst. I wasn't really around. I just started covering ETFs when GLD came out, so I wasn't really aware of how big that was. And this is the biggest new asset class situation since gold. So definitely, again, once every 20 years maybe.
I just want to put that on record. You think $4 billion for Ether?
Yeah, something like that. That seems fair, right?
Or over under 5. You're going to take the under.
I would take the under in a year.
Me too.
Okay.
I'd say the closest to this experience that I remember is when DXJ came out and we were all going nuts over currency hedging.
Yes.
And by comparison.
That, by the way, remember that was one of our trivia questions. Yeah. That was the last ETF to win the Flow crown that wasn't BlackRock or Vanguard.
Yeah.
Isn't that cool stat?
That is cool.
I think you might have gotten it, Todd.
I got it right,
yeah.
and I won that.
By the way, we need a new bet. We've been thinking, what can we bet on? So
we'll see what we come up with by the end of the program.
We're not done yet. All right, now the outflows, which is interesting. Okay, GBTC, negative 18 billion. That is a bomb. What an unlock. There's a whole can of worms there. SPY is 2,
That's because all the other Bitcoin ETFs took in inflows.
Well,
at their expense.
No, but like FTX had some legal money in there that went out that didn't go to other Bitcoin ETFs. There was some other lawsuits. I would call these like unnatural operational money that left, I think, half of it. The other half probably found a cheaper ETF.
Okay.
But definitely that is just unbelievable. No ETF has ever seen that much money come out in that sort of
And what
period.
was the figure?
18 billion.
Okay, and the next
in under 5 months.
And number 2?
Number 2 is SPY. Now, here's the thing with SPY. It's a negative 11 billion. We just talked about how great S&P 500 ETFs are. SPY took in 40 billion in December or something like that. So some of this was people going in to do tax loss harvesting. So I think some of SPY's money is leaving what went in December. So again, I'd call that operational.
But it can't get any cheaper like the others can.
That's
too,
the thing, though, is there's generally a headwind with SPY because it is more expensive.
And yet QQQ has the same problem with these investment trust structures.
I also think that QQQM still isn't liquid enough to get the trading money yet.
Yeah.
Whereas IVV and VU are actually getting so liquid that even a hedge fund will be like, I'm fine with the liquidity there. So when QQQM gets a little more liquidity, I think Qs are going to be in the same boat as SPY. Number 3 is a fascinating small caps, IWM. How about it's supposed to be the year of small caps a lot. It never happens.
Yeah, I mean, well, the interest rate environment plays a role in that we haven't seen cuts that would have been conducive for small caps. And yes, there's cheaper alternatives for getting small cap exposure, whether it's tied to the S&P 600 from iShares or State Street. The State Street small cap ETF has been actually quite popular as of late, but there's other alternatives than IWM.
So far, we've checked 3 year of favorites: international, fixed income, and small caps.
And small caps, there's another issue, whereas companies more and more, they IPO larger. So it's like they don't even get to be small caps for a little bit and get a little of that juice. So I think they're almost like there's what would you call that? Like a secular issue with the IPOs now. It's almost like when Kobe Bryant went right to the NBA and he was in no college at all. That you can't do that anymore. It's one and done. But you have to go into a college now. But small caps, the IPOs go right to the large cap area now. So small caps, I think, also suffer because they don't have any star power, right? And if you are a star, you quickly go up the ranks to large caps quickly. So you're left with a lot of junk. That's why CAF, I think, did so well. It's small cap free cash flow. So at least you're with quality cash generating small caps. And that is was a monster hit.
Yeah.
ETF of the year, by the way, in the ETF awards, remember?
Okay, but you got one more.
I do. And USMV is the fourth most outflows. Remember, that's the iShares minimum volatility. This was the belle of the ball, right, for about 5 years back then. Everybody was into minimum volatility, low
Didn't
low
age
vol.
well.
Ethan has a theory on this, is that, you know, the buffer ETFs, which target your outcome perfectly, they've kind of stolen the thunder of low vol. Because if you're a boomer and you want the stock market but with less risk, the buffer ETFs actually get you more targeted outcome than you can predict with a low vol. What do you think of that theory?
I see the merit of that, and certainly the buffer and defined outcome and controlling that plays a role. But I think also we've seen a rotation from min vol to quality. And so the iShares Quality ETF QUAL saw strong net inflows earlier in the year. And I think that's probably some of that might be a model rotation out of min vol and into quality.
Plus, vol hasn't been that high anyway this year, you know, so maybe we're not that worried.
Yeah, no, I those are definitely obviously good answers. And I think, though, the buffer, there's just more competition now for like, hey, I want the market, but I want less risk. Diet market or something like that. And Minvol used to have the whole
I mean, even Calamos that just launched the 100% downside protection ETF.
Structure protection.
Thank you. Structure protection ETF has seen strong demand out of the gate for these two new products.
Okay, Act 3.
All right, let's look at issuers. Okay, number one, no shocker here. Vanguard with $103 billion. Okay, so that's a third of all the money, just like a giant vacuum cleaner. Number two is BlackRock.
Vacuum cleaner.
What?
A Pennsylvania vacuum cleaner.
Yeah, Keystone State. I don't understand. Like,
Does it rain there?
We talking about Allentown?
I've got a visual in my head.
Talking about manufacturing jobs? I don't know. Is that Pennsylvania vacuum cleaners are really good?
It's like American made.
Yeah. I mean, look, also it's interesting. Vanguard just rolls on. I just don't see anything that really takes away from the reputational inertia they have. Not to mention, again, everybody loves cheap beta. And this is before they've really rolled in any of their active strategies with especially on the equity side. They could easily keep leading by almost 2 lengths if they were to fold in some of their active strategies, in my opinion.
Yeah. I mean, if and when they bring more of the best of Vanguard into the ETF structure, I would agree with you. But we've even seen BNDX, the Vanguard International Bond ETF, be very popular this year. You get, of course, what it says, international bonds to broadly diversify not just equities, but also overseas. That's been hoovering up money as well.
And what do you think of the new CEO? So they just hired BlackRock, Salim Ramji, who used to be the CEO, the head of BlackRock's global ETF business. It's interesting. He's a little more dynamic, I think.
And he's the
BlackRock's product line
isn't he
is
the
different.
First one who wasn't internally bred? So outside.
I think that helps, right? Do you think that helps or hurts?
I think it helps in that you can bring in a fresh perspective as opposed to just the Vanguard way of doing things. But I think he's going to keep a lot of the same things the same, and we'll see just an evolution bringing the best. BlackRock has been increasingly bringing active managers like Rick Reeder into the ETF space. I think we're going to see more of that from Vanguard.
How does $103 billion compare with previous issuer performance?
Well, I'd say it's largely on par because if you look at the last 10 years, Vanguard's taken in about $900 million a day. There's 250 trading days in a year. So they're at $103 billion. If they go to $206 billion by the end of the year, that's about $800 million. So they're just about on pace.
I totally would have done that using market share numbers in my head of what their percentage of their market share is versus the market share that they're pulling in. You were going $900 million a day and trying to do that by 250 business days? Wow.
The reason I do that is because that is a crazy stat. Not $900 million a day for like a couple months when you got hot, but like a decade. Think about that. Certain firms are happy to be $900 million total.
Okay, so for as we talk about the changing leadership, what it means for the future of Vanguard, is Vanguard's reach multi-generational? Is this like younger, different generations of investors coming in and they're all buying Vanguard? Or is this just the existing, our generation just putting more of their money within Vanguard?
It's a good question. And the people who are at Vanguard are, if they came in early, they're rich now. They're boomers. They have almost all the money in America. So it's a good point. I think translating Vanguard's message to younger people will be a challenge. Mm-hmm. But at the end of the day, once you settle down from your gambling, meme stocks and all that, I know young people like to get lottery ticket investing. Once you kind of get a little older and you have more pressure for money, I just think you're going to find your way to the benefits of a low-cost index fund. It's just natural progression.
What is the number for issuer number 2?
It's BlackRock at $65 billion. So a little over half only of what Vanguard has.
But still a strong a strong year.
Yeah.
And we talked
and it's
about
only half a year.
And yes. So we've talked about IBIT already. We talked about IVV. They've had some success. They've had success with active management as well. They made some model allocation changes. So DYNF, which is the BlackRock Equity Factor Rotation ETF, that's among the more popular ETFs for the year. BINC, I mentioned earlier, the BlackRock Active Fixed Income ETF
Look at
has
Todd
been popular.
Todd showing up.
I know a few tickers off the top of my head. I've got 3,000 plus children to try to remember. I got to throw some love to some of them.
I'm not surprised at all here. You got Vanguard number 1, BlackRock number 2. Are you going to surprise me?
But here's one thing about BlackRock's number that's interesting: is 25% of that number though is IBIT. So had they not gotten into the Bitcoin ETF, they weren't improved, then Vanguard would be over double anybody else easily. Which again, I don't think there's been a year where one issuer took in twice anyone else. So Vanguard is playing with a sort of a record situation here. And what's amazing is all that could happen despite them not having the Bitcoin ETFs, which have been real huge successes for BlackRock. And then also the number 3 issuer, which is Invesco. And then number 5 is Fidelity. Fidelity's $15.8 billion. The Bitcoin ETF is 56% of that number. So it's lifted up some people into the leaderboard and helped them a lot. That just makes Vanguard's number all that more impressive because they don't have any of that.
Yeah, but you're to the other point of it, that Bitcoin ETFs have been a game changer in the ETF space. They've appropriately gotten attention from the issuers that are not only competing on price, but some of the firms it's helping to drive their overall flows. So Fidelity, it certainly is, as well as you mentioned. Fidelity has increasingly been turning to active management in the ETF structure. So FBND, which has a tremendous long-term track record, has continued to see love and attention. I'm assuming most of that Invesco is the triple Qs and QQQM, but they've had some success also with some other products.
Yeah, absolutely. They're having a good year, I got to say. They're not normally in the top 5.
Okay, so Vanguard number 1, BlackRock number 2. I'm not that surprised. Take it away from there.
Yeah, so Invesco 3, they're not normally that high at $35 billion. JP Morgan, then there's a huge drop. JP Morgan is $18 billion, Fidelity $16 billion, DFA, Schwab, Pacer, Capital Group, Avantis. JP Morgan 18.3. Now, they've been punching above their weight for 5-6 years now, but they lost their main guy, Brian Lake. He went to Goldman, which is, it's like a division rival. And Goldman has fallen on hard times. So do you think that Goldman will rise up, JP Morgan fall a little bit?
So yes, but I think that's inevitable. Brian Lake shifting teams is going to play a part in that. But covered call ETFs have been driving a lot of what JP Morgan's success has been. I think Goldman has the in-house expertise in other areas, and I expect we're going to see product development towards active management, bringing the best of Goldman into the ETF world. And so, yes, I would expect a year from now, when you bring us back for another halftime report, we'll be talking about the success of Goldman. See, I just invited us back.
I was going to say, assumes that he's coming over for the holidays every year.
If I show up with food, you'll let me in.
The other one in there, Pacer.
Yeah, well, we went over CAF earlier, but CAF and CALs are blockbuster hits. To me, Pacer is the arc of the higher rates era. Because once rates went up, it really made cash flow so much more important. Whereas ARK stocks are a little more like, we don't care about cash flow. We just betting on the
Sell
future.
the future. Yeah.
But now that rates are up, everybody's like, where's the money? So now these are like perfectly targeted to go after free cash flow. Great stat about CAF, by the way. It's not just destroying IWM. It's beating the S&P. So it's interesting. We talk about small caps doing so poorly, but CAF managed to select 100 of them that could beat large caps. And that's why the money is so good. You know, that CAF has taken in flows every month since the pandemic. Again, it's very ARK-esque in that its number came up. The stars aligned on it. The sun shone, whatever metaphor you want to use, right when the Fed raised rates. It's like when the Fed raised rates, they sort of like, it's like the soccer ball got kicked to a different part of the field and kind of away from the growth thing into the cash flow thing.
Totally did not see a soccer analogy coming from you.
I know. I'm not a huge fan, but it just seems like a good metaphor because you have to stay home in soccer, you know, because people like chase the ball around. Like if you've ever seen like little kids play soccer, that's what I feel like. Sometimes these flows remind me of little kids chasing the ball around. But it's better to stay home because it will get kicked
And
back.
Vanguard's just sitting there like score.
Yeah. They're wherever the ball. They're the field.
They are the field. All right. On that note, Cinthia, Todd, thanks so much for joining us on Trillions.
Hey, listen, thanks for having us.
It's our pleasure. We'll see you next year.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.